Good morning, students. In our earlier segment, we have learned few basic terms used in accounting. Today, we are continuing with the same segment. Let's learn some more terms used in accounting. Let's see what's the next term used in accounting. Revenue. So what is revenue? Revenue is the income generated from normal business operations. That means amount or money received by a business entity through selling its products. Day-to-day income is termed as revenue. Next is expense. So what is expense? When there is a revenue, there must be an expense. So what is an expense? Expense is the cost of operations that a business incurs to generate revenue. That means to earn revenue, the amount that is spent by the business entity is termed as expense. So, in our earlier segment, we have talked about KFC and Cucina, isn't it? Now, what KFC does, they procure raw materials from the market and produce finished products in the form of burger, sandwiches, chicken wings, isn't it? By selling those items to the ultimate consumers, they earn money. That is termed as revenue for KFC. Now, to earn that revenue, what does KFC does? They buy raw materials. Okay? They hire people to prepare those items. They hire people to serve those items to the ultimate consumers. Whatever amount is spent on those employees is an expense. Clear? Next, see. Next is profit. So, what is profit? When normally you won't see profit, but this term is used in accounting. What is profit? When your revenue is greater than your expense, it is termed as profit. That means your income must be greater than your expenses. Only then the amount that is left will be termed as profit. Next is loss. It is just the reverse of profit. That means your expenses is more than your income, that is your revenue. So when your expense is greater than your earnings, that is your revenue, it is termed as loss. Okay, let's see another term. Expenditure. So in this segment, you have come across with the word expense, and now this term is expenditure. So what is expenditure? Expenditure is often used when people are talking about budgets. I hope you all know what is budget. It is the government's job to decide what to do with tax money collected, or in other words, to determine the expenditure of public funds. The word expenditure is more than a long way of saying expense. But in accounting, we use the term expenditure to indicate the increase in the value of an asset. That means the amount of money that a business entity spent for some benefit which does not get exhausted, means finished within a year. The benefit lasts for a longer period of time. This is expenditure. So you might get confused between expense and expenditure. Day-to-day spending, regular spending, is termed as expense. One-time spending on an asset which increases the value of an asset is termed as expenditure. That means the business incur expense every day. They spend every day. KFC, for example, they purchase raw materials every day. This is expense. But just imagine, do they purchase refrigerator, air conditioner, grilling machine every day? No. So when you spend on those assets which last for a longer period of time is expenditure. But when KFC purchase raw materials to prepare the finished products with which they are dealing, what that deals with? Providing you yummy bites, isn't it? So spending on those items on a regular basis is an expense. It is not expenditure. Clear? Next, see what we have. Gains. What is gain? So we have learned what is profit, isn't it? When your earnings, that is your income, is greater than your spending, that is your expense, it is termed as profit. But what happens? Gains and profits are the terms sometimes used interchangeably. But there is an appropriate difference between these two terms. Profit arises from events or transactions which are incidental to business are called gains. So, what do you mean by incidental? That means it does not occur always. Suppose KFC sold out. What does KFC deals with? Some yummy bites. Food items, isn't it? But KFC sold out one of its machinery and earned an amount more than they have spent on that asset. It is gain. So, does KFC regularly sell refrigerator? No. Once in a blue moon, after 2-3 years. Isn't it? So, what is gain? Gain, an amount received from the sale of fixed asset, is termed as gain. Okay? It is not profit. Profit and gain is something different. Okay? Next, see transactions. So, what is transactions? Events involving some value between two or more entities. This is transaction. So, when we call it an entity, it does not mean only business to business. It can be business to human. Okay? Involving some value. That means when KFC serve you chicken wings, after you finish having it, the waiter approaches you with a bill. You make the payment. Or you might be asked to make payment beforehand. If there is a facility for self-service, then you have to buy the coupon, show it to some other counter, and then you will be served the product. So, two or more entity. Here two, because the customer and KFC are two different entities. And what they did, they exchanged between them a value. Isn't it? This is transaction. An event means occurrence. Isn't it? Let's see. What's our next term? Debtors. Some of you might pronounce it as debtors, but actually it is debtors. B is silent. So, who are debtors? Debtors can be a human being, debtors can be a business entity. Okay? To whom goods have been sold on credit. That means KFC sold you the finished products, but you will pay them later on. the customer becomes debtors for KFC. Clear? Similarly, likewise, you have creditors too. Not necessary that KFC will purchase all its raw materials on cash always. They might have some suppliers, contractors who provide them raw materials on a daily basis, and at the end of the month or after every 2 months they collect the payment. So, the business organization or the person who are providing the raw materials to KFC are treated as or are called creditors. Okay? So, who are creditors? Person from whom goods have been purchased but money has not yet been paid. Clear? Next, see what items are coming up. Stock. Now see, due to COVID pandemic, most of us are buying lots of stuff, grocery items, isn't it? So that we don't run out of our groceries. Similarly, what is stock in case of business? It is a measure of goods at any point of time. That means goods lying unsold at the end of an accounting period is termed as goods from the viewpoint of the business entity. Okay? Next, you see discount. We all know discount. What it is? Deduction in the price of goods sold is termed as discount. It is often heard, no? Let's buy one mobile. Amazon is giving 20% discount. Means what? They are reducing their price. Actual price reduction is discount. Voucher. It is not like purchasing a prepaid card voucher to recharge your mobile or something like that. Voucher in case of accounting is a documentary evidence in support of a transaction. So, what is voucher? It is an evidence, documentary evidence in support of a transaction. You have purchased food items from KFC. Okay? You will see that you will be provided with two slips. One is to be retained by you and another is to be handed over to the person who takes order. At the end of the day, what they does? They tally it or they keep a record based on those chits or slip. That slip is known as voucher. Clear? So cash receipt or cash memo is also a type of voucher. So always remember, voucher is nothing but a documentary evidence in support of a transaction. Next, see what we have. Drawings. What is drawings? anything withdrawn or taken away from the business by the owner for his or her personal use is termed as drawings. Clear? Money or goods, whatever it may be, taken away from the business by the owner is termed as drawings. It reduces the investment of the owner. How it reduces? In the next chapter, when we proceed further, you will come to know how it impacts the investment of the owner in the business. Okay, thank you.